Money Power Fraud presents MMM, Global Systemic Exploitation of Post-Soviet Markets. Chapter 1. Vacuum Capitalism, the Psychological Opening After Collapse. The collapse of the Soviet Union in 1991 did not simply dismantle a political system, it erased the economic operating manual for 290 million people. For 70 years, capital allocation had been centrally directed. Wages were fixed, prices were controlled, private equity markets did not exist. Household financial literacy was irrelevant because there were no financial instruments to evaluate. Then, almost overnight, the command economy dissolved. Institutional disintegration. 3 simultaneous failures created the opening. 1. Currency destabilization. Hyperinflation decimated savings. Ruble purchasing power evaporated. Individuals who had accumulated lifetime savings inside state banks watched real value collapse. 2. Wage arrears and industrial paralysis. Factories shut down or operated irregularly. Workers went months without pay. The social contract, employment in exchange for stability, fractured. 3. Banking distrust. State banks were perceived as complicit in wealth destruction. There was no established private banking culture, no deposit insurance trust, no retail investment protection framework. The result was not merely financial instability, it was systemic trust collapse. Trust in currency, trust in banks, trust in government, trust in institutional competence. That is phase 0 of large-scale financial exploitation. The transition shock. The early 1990s introduced a new concept into public consciousness: privatization. State assets were transferred into private hands. Voucher programs distributed ownership certificates to citizens who had no experience valuing equity instruments. A population trained in fixed-price logic was suddenly expected to understand supply, demand, and speculative pricing. This created a structural asymmetry. Financial complexity increased exponentially. Regulatory infrastructure remained underdeveloped. Public understanding remained near zero. In mature markets, speculation is buffered by institutional literacy. In transitional economies, speculation becomes behavioral contagion. Scarcity trauma as capital catalyst. Economic collapse produces psychological residue: fear of missing opportunity, urgency to recover lost wealth, distrust of slow, conservative returns, susceptibility to accelerated gain narratives. When people experience sudden wealth destruction, they become less risk-averse, not more. This is counterintuitive but historically consistent. After systemic loss, individuals seek velocity. They seek recovery speed. They are drawn to exponential curves because linear growth feels inadequate against prior damage. MMM emerged precisely into that mindset. Absence of market memory. Post-Soviet Russia had no generational memory of capital markets. There was no lived cultural understanding of equity risk, dividend structures, corporate governance, securities fraud, Ponzi mechanics. In Western economies, Ponzi schemes rely on deception layered over existing systems. In Russia, in 1992 to 1994, the system itself was unfamiliar. MMM did not need sophisticated concealment. It operated in an environment where financial form alone implied legitimacy. Printed certificates looked official. Television advertising signaled scale. Crowds signaled safety. In institutional vacuums, visibility substitutes for validation. Regulatory paralysis. New governments were attempting to draft securities laws while simultaneously managing currency crises, political instability, asset privatization, criminal enterprise expansion. Enforcement capacity was fragmented. Oversight agencies were underfunded and inexperienced. There was no established securities culture capable of rapidly identifying fraudulent capital aggregation at national scale. This lag created what can be defined as an enforcement latency window. During that window, capital flows can expand faster than regulatory reaction. MMM exploited that window with precision. Informal capital aggregation culture. Parallel to formal market collapse, informal financial networks proliferated: street currency exchanges, private cooperatives, shadow lending, cash-based savings pools. Citizens were already adapting to informal economic structures. MMM positioned itself not as an abstract financial vehicle, but as a community wealth movement operating within that informal adaptation culture. It felt aligned with the new reality rather than external to it. The psychological formula. The environment contained 5 converging variables: institutional distrust, wealth destruction trauma, financial illiteracy in capital markets, regulatory underdevelopment, urgent desire for upward mobility. When these variables converge, large-scale pyramidal systems become socially scalable. Fraud does not require deception alone, it requires receptivity. MMM's success was not solely engineered by Sergei Mavrody's design. It was enabled by systemic fragility. Phase 0 to Phase 1. Phase 0. Trust collapse. Phase 1. Narrative-based capital aggregation. In stable economies, capital follows audited performance. In unstable economies, capital follows psychological assurance. MMM entered a society transitioning from state paternalism to free market uncertainty. It offered something deceptively simple: participation, momentum, visible gain, community validation. In an institutional vacuum, those elements were enough. This was not the birth of a Ponzi. It was the monetization of structural dislocation, and it set the foundation for one of the largest retail capital extractions in post-Soviet history. Chapter 2. The Mavrody Architecture. Engineering a pyramid at national scale. Sergei Mavrody did not design MMM as a small deception. He engineered it as a parallel financial system. The critical distinction is scale intent. Most Ponzi operators attempt concealment. MMM pursued saturation. Corporate shell as financial theater. MMM was formally registered as a company. It issued shares. It maintained offices. It printed certificates. It ran television advertisements. The structure mimicked legitimate equity issuance without complying with the underlying economic logic of equity markets. There was no audited balance sheet, no revenue-generating enterprise, no asset-backed valuation, no independent price discovery mechanism, yet it operated under the visual architecture of a public company. The genius of the design was not complexity. It was institutional mimicry. Phase 1. Capital intake layer. Retail participants purchased MMM shares. These shares had no underlying productive asset, were priced internally, were revalued administratively. Participants believed they were buying equity. In reality, they were contributing to a closed redistribution pool. Capital inflow funded payouts to earlier participants. But unlike traditional Ponzi's, MMM layered a speculative pricing model over the redistribution engine. This blurred the fraud classification. It looked like a volatile growth stock. It functioned as a pyramid. Phase 2. Administrative price acceleration. In normal markets, share prices respond to supply, demand, earnings, and macroeconomic conditions. In MMM, price appreciation was declared. The company periodically announced internal price increases. This created artificial capital gains. Urgency to buy before repricing. Social proof reinforcement. The price curve itself became the marketing engine. When participants saw exponential increases, they interpreted this as validation rather than manipulation. Price became propaganda. Phase 3. Media Amplification Engine. MMM ran aggressive national advertising campaigns. Television ads were not subtle. They were omnipresent. This accomplished 3 strategic objectives: legitimacy through visibility. If it's on state television, it must be legal. Momentum signaling. Mass participation implied safety. Normalization of risk. When neighbors, co-workers, and relatives invest, perceived danger declines. Advertising spend was funded by incoming capital. Growth financed perception. Perception financed growth. This feedback loop is critical to understanding scale fraud. Structural innovation. Open pyramid model. Unlike concealed schemes, ESMMM operated in plain sight. This created a paradox. If it were fraudulent, how could it be so visible? Visibility reduced suspicion. Opacity would have triggered concern. Mavrodi understood that in transitional markets, legitimacy is often conflated with scale. Liquidity illusion. Participants could sell shares back to MMM at the administratively determined price. This created the perception of liquidity. But liquidity was not market-based. It was inflow-dependent. As long as new capital exceeded redemption requests, the system appeared stable. This is a closed-loop liquidity structure. It functions until velocity reverses. Incentive distortion architecture. MMM rewarded early entrants disproportionately. This created evangelists, social recruiters, community-level promoters. The scheme externalized its marketing costs onto participants. Referral incentives amplified capital intake without proportional operational expense. Each satisfied investor became a distribution node. At national scale, this converts retail enthusiasm into exponential expansion. Political risk buffer. The scale of MMM created a regulatory dilemma. By 1994, millions of citizens were involved. Intervention risked public unrest, financial panic, political backlash. The larger the scheme became, the harder it was to dismantle without systemic consequences. This is strategic scaling as defensive insulation. Fraud became too large to fail? Temporarily. The core engineering insight. MMM's architecture fused Ponzi redistribution, equity market mimicry, state-era trust psychology, mass media saturation, internal price control. It was not merely deception. It was a synthetic capital market operating without asset backing. Mavrodi did not hide risk. He replaced risk comprehension with spectacle. And in a system without mature financial literacy, spectacle outperformed substance. This architecture transformed a classic pyramid into a national financial phenomenon. Chapter 3. Information Asymmetry as Weaponized Strategy. MMM did not rely on secrecy. It relied on imbalance. Information asymmetry was not a byproduct of the system. It was the core operating advantage. Absence of verifiable financial disclosure. There were no audited statements, no independent valuation metrics, no transparent revenue streams, no asset disclosures. Yet, this absence did not trigger mass skepticism. Why? Because the audience lacked a reference framework for what proper disclosure should look like in a functioning securities market. In developed markets, opacity raises suspicion. In transitional markets, opacity can pass unnoticed, especially when combined with scale and spectacle. The public did not demand audited transparency. because there was no institutional norm for demanding it. Complexity as psychological shield. MMM's internal mechanics were not fully explained to participants. The share repricing mechanism, capital redistribution model, and liquidity structure were opaque. This produced two reinforcing effects. Cognitive deferral. Participants assumed complexity implied sophistication. Authority substitution. If leadership understood the model, individual comprehension felt unnecessary. When financial systems become difficult to decode, retail participants default to trust in narrative. Complexity becomes insulation. Legitimacy through media saturation. MMM's advertising was relentless. Television campaigns featured confident messaging and national reach. Offices were visible, lines formed outside branches. Visibility became validation. This created a dangerous heuristic. If it were fraudulent, it wouldn't be this public. Information asymmetry widened because perception displaced investigation. Social proof as risk suppression. Participants did not evaluate MMM based on documentation. They evaluated it based on community reinforcement. Friends profited. Coworkers withdrew gains. Neighbors reinvested returns. This social confirmation replaced independent verification. Once enough participants experienced short-term payout success, skepticism became socially costly. Doubt implied missing opportunity. Skepticism implied ignorance. The system turned belief into social capital. Manufactured momentum. Internal share price increases created a continuous feedback loop. Price appreciation signaled growth, institutional strength, strategic success. But price was not market-derived. It was administratively declared. Participants interpreted price, momentum, as organic demand rather than engineered repricing. This is a critical asymmetry dynamic. When valuation is issuer-controlled and unchallenged, perception replaces price discovery. Regulatory signaling failure. Authorities were slow to intervene. That delay became implicit endorsement. Citizens assumed, if regulators have not shut it down, it must be legal. Regulatory latency becomes informational misdirection. In stable systems, regulatory silence is neutral. In fragile systems, regulatory silence is interpreted as approval. MMM benefited from that silence. Narrative dominance over data. The core message was simple. Participate early. Hold shares. Watch exponential growth. The narrative did not require financial literacy. It required optimism and urgency. MMM did not educate investors. It energized them. Narrative clarity overwhelmed data absence. When storytelling outpaces scrutiny, information asymmetry widens rapidly. Structural takeaway. Information asymmetry becomes weaponized when the issuer controls valuation. Disclosure norms are immature. Regulatory enforcement lags. Social proof amplifies belief. Media visibility substitutes for oversight. MMM did not need falsified financial reports. It needed belief sustained longer than liquidity pressure. In transitional economies, the informational gap between issuer and participant can be so wide that the system operates without meaningful resistance. That gap was the true asset, and it proved more powerful than any underlying balance sheet. Chapter 4. Regulatory blindness in transitional economies. MMM did not grow because regulators approved it. It grew because regulators were structurally unprepared to confront it. Post-Soviet Russia was attempting to construct a securities framework while simultaneously managing macroeconomic instability, privatization chaos, and political fragmentation. Enforcement capacity lagged far behind capital experimentation. This created a regulatory vacuum with three defining weaknesses. Detection failure. No early warning infrastructure. There was no mature security surveillance system capable of identifying abnormal retail capital concentration. No automated reporting. No capital adequacy thresholds. No stress modeling. No systemic risk dashboards. In developed markets, sudden exponential capital aggregation in a single retail instrument triggers scrutiny. In early 1990s, Russia, the infrastructure to detect abnormal growth simply did not exist at scale. By the time concern surfaced, millions were already exposed. Legal framework under construction. Privatization moved faster than legislation. The legal definitions of securities fraud, market manipulation, investor protection, corporate disclosure obligations were still evolving. MMM exploited ambiguity. If a company issues shares and participants voluntarily purchase them, is it fraud or speculative capitalism? When statutory clarity is incomplete, enforcement becomes discretionary. Discretion produces hesitation. Hesitation produces scale. Enforcement, hesitation, and political risk. By 1994, MMM had millions of participants. Shutting it down would not simply target a company, it would destabilize households. Intervention risked public unrest, financial panic, political backlash against reform. Regulators faced a dilemma: allow continued operation and risk systemic collapse later, or intervene early and trigger immediate social volatility. In transitional democracies, political stability often outweighs aggressive financial enforcement. That delay benefited MMM. Public communication failure. Authorities did not effectively communicate risk. There were no coordinated public warnings explaining the mechanics of pyramids, the absence of asset backing, the liquidity dependency. Without clear communication, silence was interpreted as tolerance. In fragile markets, perception of legality often depends on visible prohibition. Absent prohibition equals implied acceptance. Institutional fragmentation. Post-Soviet governance involved overlapping agencies with unclear jurisdiction. Responsibility for oversight was diffused. Fragmentation leads to slower coordination, diluted accountability, delayed response. Fraud systems exploit jurisdictional confusion. When no single authority claims full responsibility, systemic risk expands unchecked. Scale as defensive shield. The larger MMM became, the harder it was to dismantle. This is a strategic reality of mass market pyramids. Growth creates political insulation. When millions are financially entangled, enforcement becomes socially expensive. The scheme transforms from private fraud to public liability. That transformation complicates regulatory action. Collapse and delayed intervention. Eventually, authorities arrested Sergei Mavrodi and froze aspects of MMM's operations. But intervention occurred after capital exposure had reached destabilizing levels. The regulatory action did not prevent collapse. It accelerated it. This sequence illustrates a recurring pattern. Late-stage enforcement rarely protects participants. It primarily contains further expansion. Structural lessons for emerging markets. Transitional economies are uniquely vulnerable when privatization outpaces regulation. Financial literacy lags capital innovation. Enforcement capacity is underfunded. Political leaders prioritize stability over scrutiny. MMM thrived inside that combination. The broader insight is not historical. It is structural. Any market undergoing rapid transformation, digital finance, crypto ecosystems, AI-enabled investment platforms, can recreate similar blind spots if governance frameworks trail innovation velocity. Regulatory blindness is rarely intentional. It is often architectural. And architecture determines exposure. Chapter 5. Collapse Dynamics, Liquidity Reversal in a Closed System. MMM did not collapse because it was exposed. It collapsed because liquidity velocity reversed. Every pyramidal structure depends on a singular variable, continuous net inflow. As long as incoming capital exceeds outgoing redemptions, the illusion of stability persists. When that equation flips, structural fragility becomes visible immediately. The confidence inflection point. By mid-1994, scrutiny intensified. Media investigations increased. Regulatory attention escalated. Public debate widened. Confidence is the true collateral of a pyramid. When participants believe redemptions will be honored, they hold. When participants fear delay, they withdraw. The shift from accumulation to withdrawal is nonlinear. It does not decay gradually. It cascades. Redemption surge mechanics. As rumors circulated and investigations mounted, redemption requests accelerated. This created three simultaneous pressures. Cash demand spike. Participants attempted to liquidate shares at administratively declared prices. Liquidity compression. New inflows slowed as uncertainty increased. Queue visibility. Lines formed outside MMM offices, signaling distress. Visibility amplified fear. In a closed-loop liquidity structure, perception of instability triggers real instability. Administrative price control failure. MMM's internal repricing model relied on upward adjustments to sustain enthusiasm. During liquidity stress, the model faced a constraint. If share prices continued rising, redemption liabilities expanded. If prices were frozen or lowered, confidence deteriorated. Price control became a liability rather than an asset. Without external market pricing, the issuer was trapped by its own declared valuations. Regulatory intervention as catalyst. The arrest of Sergei Mavrodi and freezing of certain operations accelerated collapse. Intervention signaled that the state no longer tolerated the system. For participants, this meant elevated redemption urgency, reduced expectation of future appreciation, increased probability of loss. Regulatory action in late-stage pyramids often functions as an ignition point rather than a preventive measure. The structure was already unstable. Intervention removed residual belief. Velocity reversal model. Closed pyramids operate on velocity asymmetry. Inflow velocity must exceed outflow velocity. Once outflow surpasses inflow, liquidity gaps appear, payment delays occur, panic spreads, trust evaporates. At that stage, no internal mechanism can restore balance without massive new capital injection. MMM had scaled too large to be recapitalized organically. The system required continuous exponential growth to survive. Exponential growth cannot persist indefinitely in finite populations. Household-level impact. Millions of participants were affected. For many, MMM was not speculative capital. It represented life savings, pension substitutes, wage recovery hopes. The collapse deepened distrust in private equity, market reform, regulatory institutions, banking systems. The psychological damage outlasted the financial loss. Trust recovery takes longer than capital recovery. Systemic aftershock. The broader Russian financial system absorbed secondary effects. Increased skepticism toward privatization, heightened public hostility toward speculative markets, political pressure for stronger oversight. MMM did not merely implode internally. It reshaped public perception of capitalism in a transitioning society. Large-scale frauds leave institutional scars. Structural lesson. Pyramids do not fail because they are fraudulent. They fail because liquidity math is inescapable. When valuation is self-declared and redemption is inflow dependent, collapse timing is determined by confidence cycles. The moment belief shifts from accumulation to preservation, the system is mathematically finished. MMM's scale delayed collapse. It did not prevent it. And once velocity reversed, the unwinding was immediate and irreversible. Chapter 6. Reinvention. Digital resurrection across emerging markets. The collapse of MMM in 1994 did not end the architecture. It paused it. Sergei Mavrodi understood a critical truth. The weakness was not geographic. It was structural. Wherever institutional fragility and financial aspiration intersect, pyramidal systems can regenerate. MMM re-emerged years later, not as a Russian relic, but as a portable model. From centralized office to distributed cells. The original MMM relied on physical offices and national television. The rebooted versions removed those dependencies. MMM 2011 and subsequent iterations adopted online registration portals, peer-to-peer payment routing, decentralized participant cells, social media amplification. This dramatically reduced operational overhead and increased scalability. Brick-and-mortar visibility was replaced with digital ubiquity. Narrative reframing. The relaunch repositioned MMM not as a company, but as a mutual aid community. Language shifted. Participants instead of investors. Donations instead of deposits. Help instead of returns. Semantic reframing blurred legal classification. If funds are voluntarily donated, liability perception weakens. This linguistic strategy provided operational ambiguity while preserving the same redistribution mechanics. Cryptocurrency as liquidity shield. In later expansions, digital payment rails were introduced. Cryptocurrency integration served three purposes: borderless capital flow, reduced banking oversight, enhanced perception of modernity. Crypto did not change the structure. It reduced friction and regulatory visibility. The pyramid remained inflow dependent. The rails simply evolved. Geographic targeting strategy. MMM expansions targeted regions with limited financial literacy, underdeveloped securities regulation, high unemployment, currency instability, distrust in formal banking. Nigeria became one of the most significant second-wave expansion zones. The pattern repeated: rapid social media growth, viral referral campaigns, exponential onboarding, sudden liquidity freeze. Structural fragility is portable across borders. Incentive amplification through digital networks. Digital MMM iterations relied heavily on referral bonuses. Participants were rewarded for recruiting others. Growth became gamified. Online dashboards displayed projected returns. Countdown timers reinforced urgency. Community chats amplified momentum. Behavioral reinforcement accelerated beyond what analog media could achieve. Digital virality replaced television saturation. Transparency paradox in the Internet era. One might assume that Internet access would increase skepticism. Instead, digital abundance amplified noise. Online testimonials, payout screenshots, influencer endorsements. These overwhelmed analytical caution. Information availability does not guarantee information discernment. In high-velocity online environments, emotional signaling often outpaces rational evaluation. Recurring collapse cycle. Each digital MMM iteration followed the same sequence: rapid exponential participant growth, temporary payout validation, liquidity strain, freeze or restructuring announcement, capital loss, blame externalized, reconfiguration. The architecture did not evolve economically. It evolved operationally. The core dependency, new inflow exceeding outflow, remained intact. Structural insight. MMM demonstrates that pyramidal systems are not event-specific. They are context-adaptive. When regulatory maturity increases in one region, expansion shifts to another. When traditional banking oversight tightens, alternative payment rails are adopted. Fraud models migrate toward frictionless environments. The lesson is not that MMM was uniquely resilient. It is that systemic vulnerability is cyclical. As long as economic instability persists, financial aspiration outpaces literacy. Digital amplification lowers recruitment cost. Pyramidal architectures can reappear under new branding. The name changes, the mechanism does not. And in each cycle, confidence remains the only true collateral. Chapter 7. Comparative Architecture. MMM versus Classical Ponzi Systems. MMM is often categorized alongside traditional Ponzi schemes. Structurally, that classification is incomplete. While redistribution mechanics were similar, the scale dynamics and operational posture were materially different from classical cases such as Charles Ponzi in the 1920s Boston or Bernard Madoff's hedge fund decades later. The distinctions matter? Secrecy versus spectacle. Classic Ponzi structures depend on controlled exclusivity, limited participant pools, curated investor profiles, reputation-based trust channels, controlled information flow. Madoff, for example, operated through private wealth networks and feeder funds. The illusion relied on credibility and quiet prestige. MMM inverted this model. It was loud. It advertised nationally. It sought mass retail saturation. Rather than conceal scale, it weaponized it. Spectacle replaced discretion. Retail mass mobilization. Traditional Ponzi schemes often concentrate capital among fewer, higher net worth participants. MMM mobilized millions of retail investors. This altered the risk profile. Lower average ticket size, higher aggregate exposure, political ramifications upon collapse. When fraud impacts elite capital, enforcement is procedural. When fraud impacts mass households, enforcement becomes socially volatile. MMM's retail breadth transformed it from private fraud into quasi-macroeconomic disruption. Internal price control versus fabricated returns. Madoff fabricated consistent returns through falsified statements. MMM declared price appreciation administratively. There was no pretense of underlying portfolio strategy. The system openly announced revaluations. This is a critical architectural difference. Madoff simulated external market participation. MMM simulated internal market creation. One falsified data, the other manufactured valuation. Both required continuous inflow. But MMM's approach blurred the line between speculative equity and redistribution scheme more aggressively. Regulatory complexity. Madoff exploited regulatory overconfidence in sophisticated markets. MMM exploited regulatory underdevelopment in transitional markets. In developed markets, oversight exists but can be misled. In transitional markets, oversight may be structurally immature. MMM operated where legal frameworks were still forming. This reduced detection friction dramatically. Socio-political impact. Classical Ponzi collapses damage investor portfolios. MMM damaged public confidence in capitalism itself. Its collapse reinforced skepticism toward privatization and market reform in post-Soviet Russia. That scale of psychological aftershock is rare. When fraud aligns with systemic transition, its impact transcends finance. Open system versus closed elite dynamics. Madoff maintained selective access. Scarcity enhanced perceived legitimacy. MMM encouraged universal participation. Inclusion enhanced perceived inevitability. These are two distinct legitimacy engines. Exclusivity legitimacy, popularity legitimacy, both can be exploited. They operate on different psychological triggers. Speed of expansion. Traditional Ponzi schemes expand through relationship networks. MMM expanded through mass media and later digital virality. Growth velocity was significantly higher. Higher velocity increases fragility. Rapid expansion compresses the timeline between formation and collapse. MMM's life cycle was accelerated compared to multi-decade Ponzi operations. Structural conclusion. All pyramids share one invariant rule. New capital must exceed payout obligations, but the wrapper matters. MMM demonstrated that spectacle can replace secrecy, scale can replace sophistication, visibility can substitute for legitimacy. Retail enthusiasm can insulate early regulatory hesitation. It was not a refined hedge fund deception. It was a mass participation synthetic market. Understanding these distinctions is operationally relevant today. Modern financial ecosystems, particularly those built on digital platforms, increasingly resemble MMM's openness model rather than traditional secretive Ponzi structures. When fraud becomes participatory and publicly amplified, its detection profile changes, and so does its damage radius. Chapter 8. Operational Implications. Pattern Recognition in Modern Capital Systems. MMM is not merely a historical case. It is a structural template. The mechanisms that enabled its growth, valuation control, liquidity dependency, narrative amplification, continue to reappear in contemporary financial ecosystems. Understanding the pattern is more valuable than memorizing the event. Core structural indicators. Large-scale pyramidal systems tend to exhibit 5 recurring markers. 1. Issuer-controlled valuation. When pricing is set internally without independent discovery, participants are relying on declarations rather than market mechanics. 2. Guaranteed or implied exponential growth. Promises of accelerated returns disconnected from productive output signal inflow dependency. 3. Referral-based growth incentives. When participant recruitment materially sustains system viability, organic demand is insufficient. 4. Narrative dominance over financial disclosure. Emotional messaging substitutes for audited transparency. 5. Liquidity dependent on continuous inflow. Redemptions can only be honored if new capital exceeds outgoing payments. MMM exhibited all 5 simultaneously. Modern systems often exhibit them in hybrid form. Contemporary vulnerability zones. The structural model remains observable in several high-risk sectors, unregulated crypto yield platforms, high-return staking programs without transparent revenue generation, informal digital lending pools, AI-driven retail trading collectives promising algorithmic certainty, cross-border community, mutual aid investment groups. In each case, valuation, liquidity, and legitimacy may rely more on narrative amplification than audited fundamentals. Technology has changed the interface. It has not altered the dependency equation. Liquidity stress as early warning. Pyramidal systems rarely collapse without pre-collapse signals. Common precursors include withdrawal processing delays, sudden policy changes restricting redemption, incentives to reinvest rather than withdraw, promotional campaigns during liquidity strain, blame externalized onto regulators or market volatility. Liquidity compression often surfaces before public acknowledgement of instability. Monitoring redemption friction is more predictive than monitoring marketing intensity. Regulatory velocity gap. Innovation cycles now move faster than legislative cycles. Digital financial platforms can scale globally in months. Regulatory frameworks adapt over years. This creates a modern enforcement latency window similar to post-Soviet transitional gaps. The risk today is not absence of regulation. It is lag between innovation and oversight. Exploited transitional privatization. Modern systems exploit digital acceleration. The structural vulnerability is identical. Velocity mismatch. Social amplification risk. Online ecosystems amplify herd behavior. Testimonials, influencer endorsements, payout screenshots, and viral success stories create momentum independent of financial viability. The perceived legitimacy of scale persists. If millions are participating, it must be safe. Scale remains a psychological shield, but scale increases collapse magnitude. Professional monitoring framework. For institutional operators, compliance officers, and risk managers, pattern recognition should focus on revenue transparency versus redistribution indicators, cash flow source analysis, asset liability mismatch exposure, incentive distortion mapping, external audit integrity. If valuation is internally determined and liquidity depends on growth velocity, systemic fragility is embedded. No narrative can override arithmetic. Structural insight. Demonstrates that pyramidal systems do not require secrecy, sophistication, or advanced financial engineering. They require capital aspiration, institutional lag, valuation opacity, liquidity dependence, narrative amplification. Whenever these converge, large-scale capital extraction becomes possible. The lesson is not confined to post-Soviet history. It is applicable wherever rapid innovation intersects with uneven governance. The architecture remains portable, the mathematics remains constant, and confidence remains the only true collateral. Chapter 9. Strategic Defense. Building institutional immunity against pyramid structures. Demonstrates a central truth. Prevention is not about spotting villains. It is about identifying structural fragility before capital aggregates at scale. Defensive posture must be architectural, not reactive. Layer 1. Valuation verification discipline. The first line of defense is independent price discovery. If valuation is internally declared, algorithmically undisclosed, derived from proprietary formulas without audit, unlinked to productive asset performance, then exposure risk is elevated. Professional operators must demand third-party audit confirmation, transparent revenue attribution, asset liability reconciliation, independent pricing mechanisms. No internal repricing model should be accepted without external verification. Issuer-controlled valuation is a red flag multiplier. Layer 2. Liquidity stress modeling. Every capital system must withstand redemption pressure. Key diagnostic questions. What percentage of liabilities can be honored immediately? Is payout funded from revenue or new deposits? What happens if inflow slows by 30%, 50%, 70%? Are reserves independently verified? Closed systems often mask fragility during expansion phases. Liquidity stress reveals structural truth. Institutions should simulate redemption cascades under multiple inflow contraction scenarios. If collapse accelerates under moderate stress assumptions, the model is unstable. Layer 3. Incentive distortion mapping. Pyramidal systems externalize growth through participant recruitment. Indicators include aggressive referral bonuses, tiered commission ladders, compensation tied more to onboarding than performance, community pressure to recruit. When capital acquisition incentives exceed operational productivity incentives, the system tilts toward redistribution dependency. Mapping incentive architecture often exposes structural imbalance faster than balance sheet analysis. Layer 4. Governance transparency requirements. Strong governance reduces systemic manipulation risk. Defensive benchmarks should include clear ownership disclosure, board independence, regulatory registration verification, public reporting standards, conflict of interest documentation. Opaque governance structures correlate strongly with capital misallocation risk. Visibility is not transparency. True transparency includes accountability pathways. Layer 5. Behavioral risk education. Retail vulnerability is amplified by scarcity trauma, urgency marketing, social proof pressure, exponential growth narratives. Education frameworks should emphasize difference between yield generation and capital redistribution, the arithmetic limits of exponential returns, liquidity dependency risks, audit verification importance. The most effective defense against pyramids is widespread literacy in capital mechanics. Where literacy increases, scalability decreases. Institutional application. For compliance officers and risk managers, implement anomaly detection on rapid deposit growth. Monitor marketing language for guarantee signaling. Track concentration exposure in emerging sectors. Establish early warning liquidity triggers. For founders and operators, avoid internally controlled valuation structures. Maintain transparent reserve reporting. Limit recruitment-driven compensation mechanics. Separate community engagement from capital dependence. Resilient systems are built on productive output, not inflow velocity. The defensive principle. Every pyramidal structure shares one vulnerability. It collapses under sustained redemption pressure. Defense is therefore about preemptive liquidity clarity and valuation independence. MMM succeeded because these controls were absent at scale. In modern markets, technology accelerates exposure, but also enables monitoring sophistication. The question is whether institutions deploy that sophistication proactively. Fraud exploits blind spots. Defense eliminates them before capital aggregates. And in systemic finance, prevention is always less expensive than collapse. Chapter 10. The Systemic Lesson. When Narrative Replaces Governance. MMM was not an anomaly, it was a stress test. It revealed what happens when capital formation outpaces institutional maturity. The deeper lesson is not about Sergei Mavrodi. It is about structural vacuum. Capital moves toward perceived opportunity. In stable systems, governance channels capital through regulated pathways. In unstable systems, capital moves toward momentum. Where institutions are weak, narrative becomes the organizing force. MMM did not create demand. It absorbed displaced economic aspiration. Participants were not irrational. They were operating inside limited alternatives. When formal markets are distrusted and productive opportunity is scarce, speculative velocity becomes attractive. Narrative becomes infrastructure. The arithmetic of exponential promise. Exponential return models require exponential participant growth. In finite populations, this inevitably saturates. The flaw is mathematical, not moral. Even without malicious intent, any system that depends primarily on new inflow to fund existing obligations must reach a ceiling. The only variables are speed of expansion, timing of liquidity reversal, magnitude of damage. MMM accelerated quickly because its recruitment pool was national. Digital versions accelerate faster because their recruitment pool is global. The ceiling remains finite. Trust is the true asset. All financial systems depend on confidence. Banks rely on depositor trust. Markets rely on investor trust. Governments rely on monetary trust. MMM temporarily captured that trust because formal institutions had lost it. When confidence shifts from regulated systems to informal ones, risk migrates accordingly. The competition was not MMM versus skepticism. It was MMM versus institutional credibility. Institutional fragility as recurring pattern. Post-Soviet Russia represented one form of systemic vulnerability. Today, vulnerability appears in different environments: rapid technological innovation, decentralized finance ecosystems, cross-border digital platforms, emerging markets undergoing reform, economies facing inflation shock. Whenever governance lags velocity, exposure expands. The architecture of fragility evolves with context, but its core features persist. Spectacle as substitute for substance. MMM demonstrated that visibility can simulate legitimacy. Modern platforms amplify this dynamic. Viral growth metrics, public dashboards, influencer endorsements, social engagement counts. Scale appears to confirm stability. But scale without audited foundation increases systemic blast radius. Visibility does not equal solvency. The durable takeaway. Pyramids do not originate in greed alone. They originate in institutional weakness, regulatory delay, literacy gaps, incentive distortion, liquidity opacity. Remove these conditions and scalability collapses. Ignore them and replication is inevitable. Final structural thesis. MMM was not merely a fraud in a turbulent decade. It was an illustration of what happens when governance vacates faster than capital reorganizes. When oversight recedes, narrative fills the void. When literacy lags, spectacle persuades. When valuation lacks independence, mathematics waits. The pattern is cyclical. The name changes, the platform evolves, the marketing modernizes, but the dependency remains constant. New capital must exceed old obligation. And when confidence reverses, no narrative can outrun arithmetic. That is the enduring architecture of pyramids. And that architecture remains operational wherever structural weakness persists.